Hello and welcome to the next of our lecture recaps. This is a recap of our lecture on the sale of shares. We're still looking at groups here. Don't forget you can download this lecture as a PDF or any of the mind maps you see here as a PDF for free on our website shown, or indeed buy the full course on which this recap is based should you wish to do so. This time we're looking at when shares in a subsidiary are sold. So we have a subsidiary and we sell some of the shares. Again, there will be two types. We have either a loss of control, so that's when we go from a subsidiary to an investment or an associate, or we have an increase in the NCI, just like we had a decrease in the NCI when we purchased more shares. So very simply here, if we have a loss of control, well, this is where up until disposal, we'll consolidate the income statement as usual. If it's a discontinued operation, which we'll talk about shortly, we'll use IFRS 5 and present it on a single line. But we need to calculate our gain or loss on disposal. We've lost control, we no longer have a subsidiary, we'll have a gain or loss on this. This will be shown as an exceptional gain or loss and presented on the face of the income statement in the group accounts. So this is the calculation for it. Remember, this is a disposal account, so you need to make sure that you learn this working. Very, very important. It's going to be easy if you know it when it comes up. It's going to be difficult if you don't. So we take the sale proceeds, we subtract the net assets of the subsidiary at the date of disposal. So we subtract out those net assets, all of the net assets. We subtract all of the goodwill remaining. We add back in all of the NCI at the date of disposal, and we add back the fair value of any residual holding. So that will be if there's an associate or an investment remaining, the fair value of that, and that will be given to you in the exam. Adding all that up gives us the gain or loss to the group. So that's how we deal with the loss of control. We then don't consolidate the subsidiary because it's no longer a subsidiary. We treat it as an associate or an investment, or indeed nothing if we sold it all. So we did that in illustration 25, and then we looked at increasing the NCI. So this is same as when we purchase shares, except we're selling shares. The holding this time will remain above 50%. So let's say we owned 70% of a subsidiary, we sold 10% of it. Well, we still control it. It's still a subsidiary. We hold 60% in it. So our calculation for this is to debit the amount of cash received for the sale of the subsequent investment. So we'll have sold it. We need to debit cash with the amount that we sold it for. We then increase the NCI as a percentage of the net assets and goodwill. So let's say we sold 10%, we'll multiply the total net assets and goodwill of the subsidiary by 10%, and that's the amount we'll increase the NCI by. The difference between these two again will be a gain or a loss that goes to an equity reserve, and we did that in illustration 26. We also looked at some theory at this point. We looked at IFRS 5 discontinued operations just so that you'd be aware of it. Remember, if you qualify for this, you can present that operation on a single line in the statement of financial position and the income statement. And then we can have it, if it's continuing operation, line by line. So that's the difference between the two. Single line if it qualifies. If it's a continuing operation, we consolidate line by line. So to be a discontinued operation, remember it will need to have stopped trading. It could be a major line of your business or a geographical area. And there needs to be a planned disposal of this operation. So it will qualify under IFRS 5 if there's a committed plan, if it's actively marketed and immediately available, and it's being marketed at a reasonable price. The sale has to be highly probable within 12 months, and the plan can't be changing. We can't expect the plan to change. So if so, that will qualify under IFRS 5 to be presented on a single line. Just a note that when we do sell some shares, if there's a gain to the parent, there'll be a profit or loss on the sale. So that might result in a tax liability to the parent and additional tax to the group. Now, usually we just ignore this for the purposes of our consolidation. So don't worry too much about it, but just be aware that that is potentially the case. So that was a recap of our lecture on the sale of shares.